Welcome to the full-length edition of the daily video update. This is being prepared Wednesday, August 3rd, where we'll look at the action in the market today and then see how things look for Thursday, August 4th. And I'm trying this again. The internet seems to be a little bit more stable right now. And so I'll just give this a try either until the internet goes out or I go through all of the slides. We'll see which one happens first. Now, things are quite positive right now. Our indicators are looking good. Our oscillators are up. We're starting to reclaim moving averages. The scenarios that we've been looking at going from value back into growth, which helps the market go higher, that seems to be holding up. We have to be a little concerned with things moving up a little too far, too fast. That's the problem that we have in these sideways markets. Now, because of the big moves, the ADX is picking up that we're in a trend, because we're getting 1-2% moves at times, and the ADX sees that and goes, wow, things are really moving, only to see them shift around and go in the opposite direction. That is one of the problems where if we come out of a consolidation period and we start to move up, it doesn't take very much for some of our indicators to become overbought, or if we're going down, they can become oversold. So we just say overbought or oversold territory, knowing that it can stay that way for a while. We just want to be aware of that. So let's go back and talk about what happened on Wednesday. Right at the open, the futures were strong, and we ended up having a gap higher open even after the economic reports came out. We ended up seeing some buying that took us up to R1 at 41.28. And then as the day went on, we didn't see any real selling. Any small dips that we saw led to more buying. Prices then ended up climbing up to R2 at 41.64. Going into the close, we saw a little bit of selling right about the last 10 minutes or so, where we dropped down a little bit from the high, but still we were near the high. We ended up being up 1.56% on the day. Volume was actually average. We weren't above average or below average. I'm calling it right on the average. We were just a little bit above, but that is kind of a healthy sign. We're seeing some buyers start to enter the market again. We're seeing volume pick up a little bit, and that could be a pretty healthy sign. But we need to see that for more than just one day. We need to see this over a period of time. The technicals are pretty much positive, with a little of them extreme, especially in the short term. We're still really battling with this idea of inflation and interest rates. That's still the real fixation that the markets are concerned about. Of course, we have the whole list of geopolitical concerns. And then one that's off the list now that was on the list is the speaker went to Taiwan. Well, apparently, I guess that trip is over now. But we'll have to see. Are there going to be any ramifications from that? Because China didn't really like that happened. So we'll have to see how that goes. We're starting to be right in the real thick of earnings season. So as these reports come out, especially the really big companies, they can have an impact not only on their own stock price, but in their industry group, also to their sector, and sometimes all the way over into the index. And then there's still this debate now going back and forth. What is a recession? We have the textbook definition of a recession, and then we have the new way that they're trying to say a recession is, because employment is still really strong right now. So we want to keep an eye on employment and the weekly jobless claims to see, is employment starting to take a hit? Because that usually happens during a recession. Right now, take your pick. We just follow the charts based on what's happening. We don't really take a strong stance either way, whether we're in a recession or not. We just let the market tell us what it's actually doing. All right, so what are some comments? We saw that the dollar was up, not only overnight, but it was up during the day, and that the NASDAQ was also up. That's the real growth sector. That's what's going to help push prices up from here. There's a problem, though. We're seeing a real drop-off in the new highs and new lows. They're not expanding when we're going up, nor are they really going down on our down days. They're just kind of going sideways. And that's more of the environment that we've been in, where we saw these prices not too long ago, and the new highs and new lows were set at that time. And so we're still mingling around price levels that were seen just a few weeks ago. And so that's having a little trouble catching up with being anything positive. And I'll show you a chart there. We have a thing called FOMO. This is afraid or fear of missing out. And that's what happened last March. If you recall, we came up strong in the middle of March from a real downtrend, and it was really powerful, but it didn't last very long. And just about the time we hit that top, this is when FOMO kicked in, and a lot of people who follow what's going on instead of try to anticipate what's happening by having foresight, that's when they got in, and then the market ended up going down from there. We also saw that in energy. When energy became all the rage and everybody's like, yeah, this is what I'm going to do, that was pretty much the top at that point, and it's been falling down ever since. We see that over and over and over in the markets. That's why I use all these indicators, all these charts. That's why I use InterMarket Analysis. That's why we do all these things to try to help us understand what's happening so that we can see things before they happen. We don't jump on when it's too late and then have it go the other direction. Now, sometimes that will still happen, but we can really minimize that with the approach that I take with these videos and in the classes that I teach. The sector rotation is still going up. We're seeing that chart looking really nice right now, and I'll show that to you. We still have the two main yield curves. There's more than this, but the 10-year to the 2-year and the 10-year to the 5-year, those are both inverted right now, with the 10 to the 2-year being the most important one. And fear, we're kind of still in the fear area, but we're getting more towards neutral at this point. The reports that came out on Wednesday were the mortgage applications index. That actually saw an increase, where last month we saw a decrease of 1.8%. This time there was a 1.2% increase. Not very much, but still an advance. You have a lot of people kind of panicking right now. They're like, oh my gosh, if I'm going to buy a house, I better do it right now. If I'm going to refinance, I need to do that right now, because they know that rates are going up. We also had the IHS Market Services PMI. This is one of those not as important reports that we get. We still want to pay attention to this. And the thing that we can take away is that it's below 50. When we're above 50, that means this report is showing expansion in the economy. When we're below 50, that means there's a contraction or a slowdown in the economy. Factory orders were actually up 2%. They expected it to be up only 0.9%. So that was much stronger than expected. Shows there's a little hope out there. This was the important one. We had the ISM non-manufacturing index. These are the service companies. And this came in at 56.7, where they expected it a lot lower at 53.8. So that shows a little bit more hope. And that kind of gave a catalyst to say, okay, we're slowing down. These charts are going down as far as the economic reports, but this came in stronger than expected. So that helped provide some support for buying. The condition of our trend, we're now positive. The ADX has gone back above 20 and the green line is on top. So it's a positive trend. The bias, because we had an up day, is positive. And then the last 2, 3, 4, 5 days, I'm saying are positive. We had some down days in there, but for the most part, we've been showing some improvement. Let's go back and talk about the day's session. Here is the fear and greed index right now at 44, where for a long time we were down below 25, and we're starting to come up out of that. This is an Isabel net chart. This is just showing the small caps. That's the Russell 2000. I now use the S&P company, Standard & Poor's small cap index, where for a long time I used the Russell 2000, but they sold the index and it kind of got changed, and I just don't use it as much anymore. The green, my goodness, can I ever get my colors right? The dark blue line here is just showing that we've really dropped down and we're actually cheap, because this light blue line, this is at about 16. And this is showing that small caps are inexpensive right now. This could really provide some support to the market. And we've been watching small caps. That's part of our scenarios that we watch every day. So if we see some people that are willing to jump in and get some of these small caps, that will help push their prices up. and that could bleed over into the mid caps and then ultimately into the large caps or the S&P 500 that we follow. Also, we have our consolidated equity positioning where we drop down to the minus area. That was an extreme negative reading, and then we're bouncing up right now out of that. We also have, this is the percent of yield curves that are inverted, and we're right at 50%. So that's right at the tipping point as far as this chart is concerned. If we go above 50, there's a real high probability of a recession, even though we're kind of already in one according to the textbook definition. If we stay below that, then there's still some hope on the horizon that we may not get into a recession. And I've even been hearing talk now of a depression, which could be really bad. I mean, recessions are no fun, and a lot of people are hurt because of them, and companies really suffer. But a depression could be even worse. So let's hope that doesn't happen. Here's an inflation model that we have here. It just shows, and again, this is just a model. It could be right, it could be wrong. This is the PCE. Now we have the CPI that measures inflation, but we also have the PCE, which comes out with its own inflation value. And lately it's been dropping. And so according to this model that they have here, it's showing a decrease as well. So this is where the scenario is coming in that maybe inflation has reached its peak for right now, and it's going to start coming down. Now, you have a lot of people who would totally disagree with that, and some very smart people that disagree with it too. We just follow the charts and see what's happening. We don't try to get real dogmatic about our stance. We just have confidence based on what the information is telling us right now. Here's the Bank of America GDP and their PCE projections, as well as the unemployment rate. And over here on the left side where we have the solid green line, that's what's already happened. And the solid yellow line, that's happened. Where we see this yellow line, maybe it topped out and is starting to come down. Well, according to Bank of America, they see inflation starting to go down. And they start to see here, the green line, maybe it bottomed and unemployment is starting to go up. So we'll have to see how this plays out. Another chart just shows the probability. Oh, this is the same chart. This is the spread between the risky loans or risky bonds, I should say, like junk bonds, and the not risky bonds like treasuries. And it's actually been declining a little bit. If we're really running into trouble, we would see this line really spike up, but it's actually been declining. Also, we have the National Financial Conditions Index. It's still below the black line. As long as we stay below this black line, it doesn't mean things are great. It just means that they could get a lot worse if we go above the black line. Here is a look at all the different value and growth areas of the market. And this is what I follow. This is the closing value, where you see over on the right-hand side, growth was up 2.33%. It was up a little higher than that, but still, that's a pretty respectable advance. And where value, it was up, but it was only up 0.8%. And then we also can follow the mid caps and the small caps. So we saw across the board strength in all the different categories on Wednesday. Here's the VIX, where it was coming down. We had a couple of rough days there, so the VIX really started to go up. Now it's starting to come down on a closing basis, and the bar is really starting to drop. When we get a little bit concerned about this on a static number, that's when we drop below 20. That means that people are getting really complacent. They're not doing a lot of hedging. And there's a lot of different studies that you can apply to the VIX. Some of them I think might be valid. Others, I don't think as much. But the idea is when the VIX is low, it's time to go. That means get out of any long positions. And when the VIX is high, it's time to buy. The thing is, it never feels like the right thing to do. And that's why we really look at our charts. Here's a VIX of the VIX showing that overall, the VIX has really been showing a decrease in volatility until we had a couple of kind of rough days. Now it's starting to come back down, both on the bar chart and on the line chart. We're also seeing the RIDEX bear bull ratio showing a little decrease in bearish positions as people kind of say, well, wait a minute, I might stick some money in the bullish side because I think maybe the S&P is going to go higher. It's still kind of in the middle, but it's not extreme right now either way. The Ulcer Index, this is the daily chart, which really isn't helping us all that much. This next chart is the weekly chart, and this is more indicative of what we've been really experiencing. We saw a real spike up in fear, and now it's been coming back down as the S&P has been going up. And we also have the mass index. This is a weekly chart. The daily chart's not telling us anything, but the weekly chart, and if you watched last weekend's video, I covered this, where if we go above 27, that's first part of the signal. And then if we drop below this dashed red line at 26.5, this is a two-phase signal. Well, we dropped below that. And this doesn't tell us the direction, but we can pretty much conclude that it's thinking that we might go higher because we use other charts to tell us what direction we think things will go. So, and this is a longer term look. This is the weekly chart. So this could be even a little bit more powerful because it takes a longer time horizon into consideration. We're down 13.77% from the all-time high set way back in January. We're seeing the equity put call ratio declining on the daily chart. And when we look at the 5-period simple moving average, we're also seeing a decline, but it's bouncing around where it's been for quite a while now, at least for most of the summer. Looking at support and resistance, here are the daily pivot levels for Thursday's session. If you want to just pause this and look at those, if you use these, I'm just amazed at how accurate these things are. I was watching this in Wednesday's session and I went, okay, we're getting close to, this was R2, and we came right up here and pretty much stalled out at that point. It's just really interesting how that works. Here's the daily chart. Now this one, this line here, it's not really close to the moving average, but if this keeps moving, eventually the moving average, which is the 200-period moving average, it will get about to this trend line from the all-time high and then to the high that we set back in March. If we do go up, now we have other resistance that we have to deal with. We have this resistance right here that I have labeled. We have an R1 that we need to get above. If we can break above this, boy, that would really turn things a lot more positive. We still have resistance above that, but this would really help the environment to improve a great deal. You can see down on the bottom where the volume was just about right on top of the moving average. Here's the pivot points for the month of August, and they readjusted since the last time I did a full-blown video. So again, you might just want to pause this to get some different levels to deal with. Here is the Fibonacci levels where we've been able to get back above this 50% retracement, and that's quite positive. We filled these gaps. That's quite positive too. Can we break through this other resistance at the 38.2% level? So that's in addition to the resistance that I was just talking about. Or are we going to fall back down a little bit and maybe take a run at it at another time? If we can break above this sideways action, because we're not quite above the high right in here, that would be quite positive too. And that was pretty much the resistance for Wednesday's session. Looking at the sectors, the tech sector ended up doing the best on an up day. Then you had discretionary, which is showing some improvement. The one sector that ended up being down was energy. And then here's our scooter scores, just the technical analysis scores. There's only two in the 90s right now. That's utilities and energy. Even though energy got hit, the charts are still looking better for that sector. And then the lonely, really bad sector at the bottom is communication. And they've also gone into last place in our sector chart right here. You can see over on the right-hand side, the green, that is communication, where we have energy still doing the best. Utilities have shown some improvement since the last time I showed this chart, but then all of the other sectors are still negative. Here are the indexes going back to the S&P high set in January, where we show pretty much what we've seen. The NASDAQ and NASDAQ 100 have been down the most. Now they're starting to bounce. So they might be able to go up faster than some of the other indexes. And I have to clear my throat again. Sorry about that. Okay, technical alerts, really, we only crossed above different levels. The S&P was able to get above 4,100 right after the open, and the rest belonged to the NASDAQ as the day went on. So here is the intraday chart. We gapped up and we immediately went up to R1, We didn't see an attempt to come down and fill the gap right here. We went sideways, and then some more buying came in. That took us all the way up to R2. And then as the day got to near the close, we saw a little bit of selling right at the close. So it was a pretty positive day overall. It started positive and stayed positive during the day. Here's our ADX. We've gone above 20, not by very much, but we are above 20 now. We're above the moving average, and the green line is on top. So this is showing a positive trend. Here's the Arun showing the buyers are pegged to the top. That means they're in control, and we're seeing a decrease in the selling. So our oscillator, after getting kind of an extreme reading there for a few days, came back down and is starting to show some improvement. Breadth, we're also showing an improvement based on price. We're above the moving average. We're still below the moving average based on volume, but it continues to advance. Here's the advanced decline ratio, where it got almost up to an extreme positive reading, fell back down, and is now showing some improvement. This is the concern right now. As we've been going up with the S&P, you see how the new highs and new lows have really flattened out right here. That's because of all these other areas that we were in not so long ago. If we can break above this to the positive side, then we will likely see a real expansion of new highs. But looking at the 5-period moving average, that's starting to turn down, and even the 10 moving average is flat to slightly declining. Accumulation distribution, also above the moving average. The moving average is going up, so that is positive. Some short-term charts. Decision point, they have the short-term based on their trend model and the PMO as being positive. The other areas are either neutral to negative right now, but you got to start in the short term before you get to the intermediate or long term. Here's our moving average tree. Now we're dealing with the 100-period moving average. We got above the 20 and it's starting to turn up. We got above the 50. It's starting to turn up. Can we get above the 100-period moving average? And then maybe make a go at the 200-period moving average. Here's our Stochc RSI showing we're extreme positive, as is the Williams percentar. Force index, it's positive and not necessarily extreme. I have some Keltner bands right here. They're similar to Bollinger bands. When we get to the outside here, that means that it's going up pretty fast, but not right now anyway. This is a little bit of a concern too. The Swinland Trading Oscillator, we had a pretty solid up day, but based on price, this indicator went down, and it went down based on volume as well. Sometimes this has been leading us, so we just want to be aware of this. McClellan Oscillator, after giving us an extreme positive reading, has dropped back down, has since recovered a bit, and just on the verge of going extreme positive again. We're seeing an actual decline right here with the 20, a little bit of an advance with the 50, and a little bit of an advance with the 200-period exponential moving averages. Stochastics, they're looking pretty toppy right now in the short term, intermediate term, and even the long term. Some intermediate term charts. Here's the 100-period moving averages that we're dealing with, both the simple and the exponential moving average. We broke out above that. Can we stay above it? If we come down, will either one of these provide some support? Rate of change, and this is the only rate of change chart that I have right now, going back 20 periods, where we're looking a little extreme positive currently. The Sean trend meter, haven't shown this in a while. We're back up into this green area, and this is showing a much improved situation. The RSI, based on 9 periods, it's looking a little extreme positive, where the 14 still has a ways to go, but both of these are positive overall. The fib retracement, we're coming back into this crazy area, and we're right about at the high set right in this mess of bars that we had. Can we break above that? Can we get up to the 50% retracement level? Or are we going to wait, go back down, consolidate a little bit more, and then give it a try? Or are things going to turn around and just go in the crapper? We'll have to see. PMO, looking positive across the board. PMOs that are rising, little extreme positive, turning down a little bit with the buy signals because we're messing around with price levels that we've been at before. But the PMOs that are above 0, that is continuing to advance. Chaikin Oscillator showing a little bit of weakness. That's a little bit of a warning sign there. And the Chaikin Money Flow also showing a little bit of weakness. They're both still positive, but they're showing some weakness on an up day. Volume is picking up a little bit now. And then the vortex. This is strong positive. We have the green line on top and breaking away with the red line on bottom and breaking down. You could make a case that it's starting to get extreme negative with the lack or with the seller signal going down. Summation index based on price and volume continue to be positive. All of our oscillators continue to be positive. The BPI, even when we had some trouble, it was inching out gains day after day after day. Now we're getting a little extreme right now. Ease of movement also showing some improvement lately. Ultimate oscillator turning back up, not necessarily extreme. Here's our intermediate term rainbow. We're starting to come out to the upper side. If we fall back down, will one of these moving averages act as support? You see the shorter term moving averages are starting to turn. Can we have this ribbon or rainbow start to flip-flop and look more positive? The CCI 14 is extreme, as is the CCI 20, extreme positive. Money flow looking positive. TTM squeeze still looking positive and above the moving averages. Our different charts. The Heiken Ashi, positive. Kegi, positive. Renko, positive. Three line break, positive. Point and figure it's drawing some new things in here, but it's suggesting a triple top breakout right now. And it's showing that on the weekly chart as well. So this could be quite positive if we don't lose it. Our different trading systems, we're back to positive with the elders, with the SPY, or the SPX and the SPY. The SAR continues to be positive with the dots below. The go, no-go system is positive now. Long-term charts. This is the longer-term rainbow. We're about halfway through it right now. These might act as resistance if we go up. They may act as support if we start to go down. Then our moving average study, getting a little topsy with the 50, showing some improvement with the 150 and 200. Special K starting to turn up ever so slightly, but it's going to take a long time for this thing to cross back above the moving average. You got to start somewhere. We're neutral with the diamonds. And here's the Dow, where we've been kind of going more sideways. The S&P, the NASDAQ, they're the ones that did better on Wednesday. The Qs are now back to positive after spending one day in neutral land. Here's the NASDAQ 100. We do have some overhead resistance at R1, but we're above the 50-period moving average, and it's starting to turn back up. Here's the Vixen. As we go up, we're seeing the Vixen coming down, both with the bar chart and the line chart. Here's the NASDAQ itself. We still have overhead resistance to deal with. Mid caps, they've been more or less going sideways, and I'll show the small caps later. Here's the Wilshire. This is a broader based measurement. It's showing a bit of a breakout here, but we're not exceeding this high back here yet. Can we do that? Broad market, the dollar, which had been showing some recent weakness, even though it's in an overall uptrend, really bounced back. And again, it was up with the S&P up as well. Here's the correlation chart where you can see we turned up a little bit because it's like, wait a minute, they're going in the same direction, where they're not as strong as an inverse relationship as they were. Boy, that was hard to say. Gold saw a little nice bounce, but now is showing a bit of a retreat after a recent death cross. Silver also bouncing up a bit, could possibly be showing a bit of a retreat. And here's, why do I have two silver charts here? Oil is getting down to the 90 level now. Ooh, wouldn't that really help some folks at the gas pump? Okay, and there's a whole political backstory to that too, but we just follow the charts, at least when we're talking about the markets. Bonds showing a little bit of an improvement after building that base, but still in a negative trend. The world bonds, after going back down to the COVID low, are still showing a bit of a bounce. Then looking at our yields, we have the 10 to the 5, it's still negative, and the 10 to the 2-year is also negative, and it continues to decline. That's kind of interesting. This is the one we're watching. This is the 10-year to the 3-month. It has not inverted yet, but if it drops below this zero line, man, the financial media is just going to have a heyday with this. And like Edward Yardeni, this is the one he watches. So he'll be much stronger into the recession camp if this ends up going inverted. Here's the tech sector to the 10-year yield correlation, still a pretty strong negative or inverse correlation. Government bonds, the treasuries, after really showing a decline, they bounced up over the last day or two, and they're crisscrossing and just going all crazy right now. Our scenarios. This is the stocks in the S&P that are above their 200-day simple moving average. We went and gave an extreme negative reading, and we continue to bounce up out of that. So that continues to be a valid signal. Then we look at the 50-period moving average with the S&P bouncing up, even though it fell back down a little bit. The mid caps also bouncing up, and the small caps. So we see confirmation now in different indexes. Here's the equity put call ratio longer term chart. We're still working off of this spike, and then it's been coming down. We still have a ways to go with the moving average before we get to a real complacent period. Then here's the small caps. They've been going more or less sideways recently, but they've been hanging in there. And here's the small cap ratio. It actually declined a little bit. So we saw this little spike up recently, and it's been falling back down and then bounced back up a little bit. That could be giving some support to the S&P 500. Can that continue? Here's the S&P to the 10-year yield. They're still in a pretty strong inverse relationship. Didn't they show that chart? Why are multiple charts showing up here? The Kopit curve, it almost started to negate the signal that we had, but it's still showing that it's giving us a signal. Doesn't tell us the direction. We can pretty much see that by what's happening right here. The Pring bottom fisher, I don't have that chart because that signal's now gone away. Here is the sector rotation. We're seeing an advance with the Qs against the SPY. Discretionary had a really nice move up, and large cap growth had a nice advance against large cap value. And here are the other. Here's the large caps again. Mid caps going up, and the small caps are going up as well. 2-year treasury yield. Is it spiking and coming back down? Well, it's starting to go back up a little bit. So we just want to be real careful with this right now. The staples, after giving us a recent death cross, they've actually been able to go back above the moving averages. Will that change things at all? But when we look at this is still declining because you have the S&P outperforming staples. So this spike still looks valid for right now. And that marks a pretty significant bottom in the S&P 500 if that holds. So what's our outlook then for Thursday? The technicals are positive, but they're starting to become especially short-term overbought. Be a little careful. Sentiment still continues to improve as we go up. The reports coming out are jobless claims, and really we want to keep an eye on the 4-week moving average of that report because it can be some crazy number for 1 week. We want to see what is the average doing. Then we have the trade balance coming out, and then all the different geopolitical events. My goodness, Russia, Ukraine, China in the supply chain, China and the Speaker of the House, China, Taiwan. Okay, not really a big thing with the markets yet, but could come to the forefront at any time. Inflation and interest rates, which also produce growth concerns. Oil, which now seems to be dropping down below 90. Earnings as they come out, different Fed speak, especially if Chairperson Powell gives some kind of a talk or interview. That's the important person to really follow. The other folks, they can say whatever they want, but it's the chairperson that really is the head of the Fed. We have the longer term situation in Japan that I've addressed before, and then recession. Are we, aren't we? What's a recession? What's the definition? Blah, 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 blah. So our scenarios, what could get us down from here? All the things that I just talked about, and the fact that we are getting to the point of being short-term overbought. We are now in a positive trend because the technicals are positive. There's a real disbelief. The market's not going to go higher. And this fear of missing out that may happen or may be happening. We have our possible positive scenarios and our sector rotation with our positive setups. Those are all still looking good right now. Technicals showing a lot of improvement. We're starting to reclaim moving averages. We're starting to break above pivot levels, fib retracements, and other levels, except for that one from a few weeks ago. Or if we could get above that high, that would really help things a lot. And we're not sideways now because we're above 20 and we have a positive trend. So our conclusion then, the S&P is positive and showing improvement. Short-term positive, but could be becoming overbought. Intermediate term also, if we see some more solid up moves, could become overbought. Long-term, we're still negative because we're below the 200-day simple moving average. So thank you. I think I got to the end of this without losing internet. So have a really, really good Thursday. I'll do my best to prepare a video before Friday's session. Whoops.